Hello students, my name's Professor Dominic Paoloni. I want to welcome you to commodity hedging. Commodity hedging is something that I pushed for at the university for a number of years, and about 4 years ago they let me teach a class on commodity hedging. This is probably the most important course that you'll take within the Commodities Center. Now, I say that, and I'm sure that a lot of professors that teach at the J.P. Morgan Commodity Center say this. However, I believe that understanding that commodity hedging really is why exchanges today exist. If you think about the origin of our country and about how this country really grew up around first the East Coast, the colonial states, the 13 original colonies, as trade and as the country grew and as the migration to the West, Chicago essentially became the hub or the center of the United States when it came to bringing in corn and cattle and wheat to feed the nation. And the interesting thing about that is that you had farmers and you had cattle, people raising cattle, that needed a marketplace where they could feel like they were able to make a living, money. So if you think about it, they go to their local regional bank. That's all there was back then. And they went to the banker and said, hey, listen, I need to borrow money to plant seed, and I want to sell the corn and the bushels of corn or wheat on the market in the fall. The banker would say, well, what if there's a drought? What if there's bad weather? What if there's storms? How do you know? How can I be assured that you're going to pay back your loan? Other than the fact that if you have 1,000 acres and you can get so much per bushels per acre. So these exchanges, the Chicago Board of Trade, basically businessmen got together and said, is there any way we can guarantee the prices to these cattle and pig raisers and wheat and farmers? They could define their risk today for tomorrow, if you would. And so they created an exchange. The Chicago Board of Trade basically started to create what we call forward contracts and future contracts, where standardized contracts where people could lock in the price of their corn for September, and it might be April or May. And so the exchanges were started as a hedging tool. Today it's interesting because many commodity companies, to oil companies, to gas companies, to copper mines, to gold mines, don't hedge at all, don't use any type of hedging, any exchanges. The majority of them don't. And of course, the ones that do, I think, don't do it very well. So what we're going to do in this course is, this is an intense course. It was a 16-week course, and we've really put it down to only master students and 8 weeks. So we're crunching a lot of material into 8 weeks. And in 8 weeks, you're going to learn, first of all, the tools, the hedging tools, which is going to take about half the semester, a little bit more. Right around the midterm, we're going to move more into how we take these tools and we use them to hedge. We use them to protect our prices, to build hedges that don't blow up. We're going to spend the whole 8 weeks reading every week about case studies. And these are companies where their hedges blew up or companies where the hedges worked. And we're going to examine in the last couple of weeks of the class how and why these hedges blew up. And then, of course, understanding the tools, how we could have built a better hedge, how we could have built a better mousetrap. There's some things we're going to teach you in this semester or this class, 8 weeks, some proprietary hedging strategies that we use at the firm that I run, IPS Strategic Capital. And we are a firm, a risk management firm. We're a derivatives firm. We trade derivatives for oil companies, gas companies, farmers, as well as for the capital markets, whether you're hedging the S&P 500 or whether you're hedging oil. It's really the same ballpark. So it's really exciting. I'm really glad that you're able to take the class. We're going to jump right off this week. As you know, we're into really the first couple of chapters of somebody that I've known over many years, Shelley Nattenberg, that we're going to use the first 8 chapters of his book, which I think he's one of the godfathers, if you will, of the hedging industry. And then we're going to move into a lot of proprietary trading, a lot of, we're going to talk about cross-asset, we're going to talk about structural hedging. A lot to learn in 8 weeks. Looking forward to really The material that you're going to learn, there will be hours where you could talk to my TA and ask him questions, as well as I'm going to put various Zoom hours up. Don't really require that you go to the Zoom classes. They're just there to answer questions. And if students can attend and click on the Zoom, great. But they're really just for Q&A, and they're probably an hour or two a week that I'll make myself available on Zoom if you want to pop in and ask a question. But this is an online course. I know most of the people here are working, and so don't want to really put too much emphasis on participation. I want you to learn the material. And there'll be enough quizzes and material to say, okay, they've completed the course and they get a passing grade. You're here to learn something. You're here to get a passing grade so you can get that commodity certificate. And that's what we're going to do. No baloney, no. Listen, I'm an adjunct, okay? I'm a practitioner. I'm not an academic. I spent my whole life working on Wall Street and then moving on from there. So I'm a no mess around guy. Let's get it done. Let's learn it. Let's take it to the next level. So looking forward to working with everybody in the class, and good luck to you.